Hey, it's Dr. Tom Nacella from the Strategic Chiropractor and strategicdc.com, and today I'd like to speak to you about how to prevent insurance contract catastrophes before they happen. It's no secret that chiropractors are all fighting declining reimbursements, and a growing portion of fees are being pushed onto the patient by insurance payers. In fact, according to Athena Health Payer Review 2012, the weighted provider collection burden increased by 7% between 2010 and 2011. In other words, your patients are being forced to foot more of the bill, which then increases the burden on you to collect it. Because these moves are precisely calculated by insurance companies, chiropractors tend to feel powerless at times. As a result, we often sigh and continue to take the beating, and while reality dictates that we cannot win every battle, we can minimize the damage done to us by insurance payers by learning to recognize which ones will give you the biggest headache ahead of time. Certainly, you could easily say that no insurance plan is ideal, but with a little bit of homework and foresight, you'll see that certain plans spell more bad news than others. Here's how to spot the rotten apples. Number one, examine contracts carefully. Although it's seldom done, chiropractors can often smell the El Stinko insurance plan just by reading the fine print in the contract. In fact, you are making a major mistake by simply signing contracts, even renewal contracts, without bothering to read them. This may sound like common sense, but unfortunately, from the number of chiropractors who actually do this, the good sense to read the contract first is not all that common. Here's some best practices. If the insurance doesn't let you see the whole contract up front, including the fee schedule, that should be a red flag telling you to prepare to be abused down the line. Similarly, if you're asked to pay a $150 application to join a network but haven't seen the fee schedule yet and what the network restrictions are, put your checkbook away. Another one, if you haven't heard of the insurance that it's asking you to join, then ask to see a major list of employers or list of major groups they have in their network in addition to the fee schedule. Unfortunately, over the last several years, we've seen the rise in what I call mystery networks that exist on paper but have actually no patients and no employer groups. The only thing these mystery networks do, and often with PI cases, is to get you to agree to discount your fee. Then, when the good-paying PI case does come your way, you suddenly discover that due to your participation in the XYZ Ghost Network, your full fees are then reduced to their contracted rate. Number two, compare the fee schedule. Even if you're reading the contract and willing to further investigate the plan, the next step is to evaluate how much it will pay you. Look at the plan's fee schedule and compare it to your current payers. Is the reimbursement higher, lower, about the same? If the rates are lower, you may want to toss the plan, but how low is too low? Again, here are some best practices. A basic benchmarking step to evaluate a fee schedule is to compare it to Medicare, which we know doesn't pay profitably, and to one of your best paying insurance plans. Here's why. We already know Medicare's fee schedule for chiropractors is pitiful, and for many of you, not even profitable. So why would you want to sign a contract that rates even lower than that? On the other hand, if the fees are comparable to one of your better payers, it may not be a bad plan. Number three, compare coverage. Sometimes looking at the fee schedule will not reveal enough. You need to look closely at the coverage that the plan offers so you don't make a superficial mistake. Here's some best practices. Do the math. For example, let's say Plan A will give you 6 visits that we would reimburse for our average services we perform at, let's say, $50 per visit. So you can anticipate a total reimbursement of $300 from that plan, plus whatever the patient responsibility is. Plan B, on the other hand, covers 8 visits, but it only reimburses $30 per visit for a total anticipated reimbursement of $240. Obviously, one looks a little better on the surface, but some digging reveals that that's not necessarily the case. Number 4, factor in your visit average. You may be satisfied with the rates that you see in a plan's fee schedule, but don't accept them until you've seen how many visits the plan offers and compare that to how many visits your patients average. For example, if the plan covers 12 visits and most of your patients average about 6 visits, well, the plan might be sufficient. On the other hand, if you normally see a patient 24 visits and the plan only covers 6, then you're going to have the bulk of your care non-reimbursed. So you need to be aware of what kind of patients you normally treat and how quickly you treat or discharge them. Number 5, don't be afraid to drop an insurance. Many new chiropractors opt to sign low-paying contracts and become providers for every network and for lousy networks because they feel like some cash is better than no cash while the practice grows. However, be sure this move doesn't continue on indefinitely. Make a note to revisit the contract after you've established yourself, because in the long term, a contract like that doesn't make a lot of sense and you may want to let that plan go. Best practices. Each year, you should review your contracts and your 1099s from payers. Weigh the facts and make a good business decision, not an emotional one, on whether to continue doing business for that payer. For more strategies on this, you might want to even see my article, How to Drop an Insurance Company, that's located at strategicdc.com. All right, this is Tom Nacella from Strategic Chiropractor and strategicdc.com. I hope this helped you evaluating your insurance contracts. Take care.